Hi, my name is Sindri and I'm going to explain why Swatch Group is currently underpriced, warranting a buy recommendation with a 13% upside.
Swatch Group is the world's largest watchmaker and currently owns 18 watch brands who bring in the largest share of revenue. While also making components and electronic systems, the watches and jewelry have been the biggest driver of growth, with a brand portfolio that covers all price points and biggest markets in Asia. The competitive advantage provided by brand diversification and vertical integration is reflected in consistent profitability and margin development, as well as the ability to outperform Swiss watch exports in difficult times. It also makes Swatch more resistant to adverse developments in individual price segments, which explains the less volatile CFROI history in comparison to its main rival, Richmond. The group has traded down considerably since late February and is currently at a 20% economic price earnings discount to the sector, which implies the lowest CFROI in the group's history and contrasts sharply to the whole default scenario. We'll now employ the three-driver model to estimate the group's fair value and base our assumptions on current and expected developments. Starting with sales. Despite slower export growth and a decrease to the group's largest markets last year, we're likely to see healthy sales growth in the middle-range brands and a slight increase in the luxury segment in China. Growth opportunities in America, as well as some fast-growing emerging markets, also have potential to boost sales as long as the industry addresses some barriers to trade. A 6% sales CAGR over the next 10 years is therefore reasonable and conservative given that the 10-year historic CAGR is around 8%. In terms of EBITDA margin development, Swatch can leverage its pricing power in order to fight unfavorable exchange rates. They've so far been quite successful, as shown by the margin improvements despite strengthening of the Swiss franc. Declines in precious metal prices, as well as synergies with recently acquired Harry Winston, will further help margins in the short and medium term. However, as 2013 margins were boosted by legal case winnings, we expect margins to drop to 25% and decline through year 10. Finally, although the group's high degree of vertical integration brings considerable advantage, it does leave the group trailing its peers in asset turns. This is not expected to change, and asset turns are therefore kept at 0.4. When put together, we get a share price of 601 francs per share, with a 13% upside, which is broadly in line with analyst consensus. In the end, it is the large brand equity, diversification across price points, and vertical integration that has made Swatch successful, and it seems to be what the market is forgetting when it factors in a difficult market environment, thus considerably underpricing Swatch. Finally, I'd like to thank you for the opportunity and for taking the time to review my presentation.